Welcome to our 2022 webinar series, Risk Management with Insurance in a Post-Pandemic World. The COVID-19 pandemic taught us to adapt and accelerate trends socially, technically, and environmentally. As we inch into a post-pandemic world, risk management continues to be top of mind for most of us. Each month, you'll learn about insurance solutions you and your clients can consider, plus the significant impact to insurers and their post-pandemic strategies. Each webinar will last about 50 minutes, and you must be logged on for a full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them by typing them to the questions box. We'll get to the answers at the end of the presentation. Today's webinar is being recorded and will be posted on our website within 24 hours. Today's presenter started working at LLIS in 1998. Since then, she's become LLIS's go-to person for connecting your clients with long-term care insurance solutions that meet their needs. Here to present on planning the future with long-term care insurance is Jill McNeil.
Hello, everybody. Thank you, Claudia. Thank you for joining us today. Well, November is Long-Term Care Month, Long-Term Care Awareness Month. So that's why we're going to talk about long-term care, my favorite month of the year. So what are we going to talk about today? Well, I'm going to start by giving you some facts and some charts, some information about how much care may cost, where care may be used, and then we're going to talk about how COVID has impacted this. Then we'll move into talking about when's a good time to purchase long-term care insurance. Again, I'll give you some charts and figures and information on this. Then we'll talk about long-term care solutions, products that are on the market, look at the different products, how they work, and compare them in their benefits and their premiums. Then we'll talk about what's new in the long-term care industry. Specifically, we're going to talk about the states that are considering a salary tax to fund state long-term care programs. And then we'll finish up with a quick case study for a male age 40 in Pennsylvania if he's considering buying a policy to avoid paying the tax. So let's get started. Long-term care in the U.S. The U.S. has the largest number of nursing home residents in the world. And a few years ago, we realized this may not be the most ideal place for our seniors to receive care because 23% of COVID deaths occurred in nursing homes. COVID is reshaping the way Americans care for the elderly and probably reshaping the way your clients are thinking about planning for the future and if they need care in the future, if they have a long-term care event. Nursing homes that may have been their choice for last case may have been their choice to receive care if they really need it. They're going to think second about that. And even before the pandemic, nursing homes were having financial troubles. They were facing hard times. Pre-COVID occupancy rates in nursing homes were down. And then the pandemic hit, and then in June 2021, nursing home occupancy rates were down to about 68%. Now that we're coming out of the pandemic, those occupancy rates went up to 78% in 2022. I think there's still concerns before somebody enters a nursing home, concerned about the quality of care received in the nursing home. So more people want to receive care in their home. And as a result of that, the national median cost for home health care increased by 12.5% in 2021. So several reasons for that increase. The main thing is supply and demand. As we said, a lot more people would like to stay in their home as long as they can. And there is a shortage of workers to provide care for home care. These workers that in the past would have been providing that care, they can now earn higher wages working in other areas, even fast food, retail, or warehouse, or moving into areas where they can work in a nursing home or assisted living. So home cost for home care was increasing before the pandemic, and it's even increasing more now. So let's look at cost of care around the country. So these are the median cost of cares or the average cost of care around the country. These costs vary greatly depending on where you live. New England, California, those areas are very high cost of care. So when you're working with your client, talking about the future and what they may face with if they have a long-term care event, look at cost of care where they are or where they plan to retire to. So the average price of a private room in a nursing home, $108,405. Semi-private room in a nursing home, about 95,000. Assisted living, 54,000. Home health aid, 61,776. Homemaker services, 59,488. You may be wondering, what's the difference between a home health aid and homemaker services? Well, home health aid comes in and provides more hands-on care, assistance with bathing, dressing, eating, whereas homemaker services provides assistance around the house, such as grocery shopping, food prep, and cleaning the home. And so you can also see that I've included the percentage increase of these costs from the year before. And not surprising, those increases for nursing homes are not that high because, as I said, people are sort of staying away from the nursing homes unless it's a worst case scenario. Assisted living's gone up a fair amount, 4.65. But again, look at these home health aid costs. Look how high they are, 12.5 and 10.69. So another reason those costs are higher is because the cost of care is so much higher because there's other services that have made it more possible for people to receive care in their home, like senior meal prep services and senior recreational centers. So people can stay in their home longer because of more assistance. Here's a chart that I found that shows where care is received. So this is talking about for traditional long-term care claims. And look at this. 73% of claims begin in the home. 18% in assisted living, and nursing home 9%. And I think this number is really important for me when I'm designing a policy for your clients to look at care costs. When we're trying to determine what daily or monthly benefit a policy should have, I recommend they at least have a policy that would cover 100% of home care costs in their area. And usually, if they have 100% of home care costs covered, they should have at least that would mean they would have at least about 50 or higher percent of nursing home costs. And here's another chart that shows long-term care policy usage, why claims end for traditional long-term care. 67% of claims end in death. 20% of people recover. They may have been sick, needed some care, and then they can take care of themselves again. And 13% of policies end because the benefits are exhausted. So I think this is important. Your clients that think they need a long benefit period, or those clients that feel that they really need to have unlimited benefits, well, in reality, only about 87% of people need unlimited benefit periods. We can still get unlimited benefit periods, but it's just really the need is not there. If your clients have some family history of Alzheimer's or dementia, yes, they may want a longer benefit period than the average person or even those unlimited benefit periods. Here's one more chart that shows when claims begin. So again, we're talking about traditional long-term care. You can see the age group between 80 and 84. About 27% of claims begin then, and then it goes down. Age 90, 94, 95. I think the result of most people don't live that long, so we don't have that many claims starting at those ages. And important to look at these numbers because when designing a policy, if your clients are in their 50s or 60s when they're applying for coverage, it's very important to put an inflation rider on their policy because you can see they may not go on claim for another 20 or 30 years. If they don't have that inflation rider on their policy, the benefit's not going to keep growing to keep up with the inflation. So when you're talking to your clients about planning for the future and when they think about, okay, if they have a long-term care event, how are they going to pay for it? Well, most people, their first option is to self-fund. By that I mean to pay for the care out of their own savings or income or assets. So if that is their plan, talk to them about this, the impact of this on their income and the assets. If they have to pay for the care out of pocket, how would that affect their ability to pay for their day-to-day expenses? And if they need care early in retirement, they may deplete their income for the remainder of their retirement years. So again, if your client has an event early on, let's say they have a stroke, they need care for a couple years, and then they recover during the time that they needed care, they may have really depleted their assets and affected their lifestyle for the rest of their retirement. And also, if one spouse becomes sick and they deplete their assets and maybe that spouse passes away, their surviving spouse is left with fewer assets to live on. And talk about the impact on their family members if they use their savings to pay for their care. Um, when there's not a plan in force, a policy in force, and the people are self-funding, majority of clients depend on their own family to take care of them. So uh, this can really have a impact on the whole family. So, because usually the burden falls to the wife or the spouse or a child, and that can really put a lot of stress on the family. And if they do, they may do use their savings to pay for their care. They're going to have less assets to leave as a legacy to their family members that they want to leave something to. So the other option when we look at paying for care is option two is to transfer the risk by purchasing a policy, either a traditional long-term care insurance policy or a linked benefit solution such as a hybrid life with long-term care or a hybrid annuity with long-term care. By purchasing one of these policies, they're going to help protect their income and assets. They don't have to spend down their assets to pay for their care, and they can protect assets for the legacy to leave to their family. And by having a policy, it also allows them to provide have choice and control on where their care is received. They can take their time and decide, okay, do we want to have care in our home? Do we want a nursing home, assisted living? And they're not going to be as dependent on government programs or family. Not going to worry about Medicaid so much. When they're dependent on Medicaid, they have to go where Medicaid sends them or receive care where Medicare sends them. And they have a choice of care settings: home, assisted living, or nursing home. And many of these policies provide a care coordinator. So a care coordinator will come into the home. Let's say mom or dad have a stroke, and then the family all of a sudden has to come up with a plan for care. The care coordinators provided by the insurance company, they will come into the home and help create a plan of care. And they will provide lists of caregivers and also facilities. So at a time of need when everybody's stressed out, having a care coordinator to come in and help with all this is very beneficial. And by having a policy, you're allowing your family members to manage your care, not provide it. So I've said this before other times, but I want to say it again. Having a policy is a gift to your family members. So now let's move on and talk about when's a good time to purchase long-term care insurance. I receive this questions a lot of very often. What is a good time for my clients to purchase long-term care? There is no magic age or no ideal age, but I'm going to show you some numbers here and some charts to help you realize why it's usually always better to purchase when you're young and while you're healthy. So here, let's say Karen, and Karen's looking at considering and purchasing a long-term care policy. She's looking for a policy with a 4,000 monthly benefit, 3-year benefit period, 3% compound inflation, 90-day elimination policy. So Karen, age 45, if she buys the policy today, she will have an annual premium of $2,546. Well, she waits 5 years to purchase that policy at age 50. She's going to have to buy a bigger policy because remember that policy had a 3% compound inflation rider. So in 5 years, that $4,000 benefit would have grown to 4,502, and premium for that would be 3,181. I'm not going to go through all these numbers, but you can see the longer you wait, the more expensive it's going to be. Before age 60, every year you wait, premiums increase by like 2%. Once you reach age 60, the premiums increase by about 6%. Okay? So you may be thinking, okay, well, that's fine, but what if I wait several years to buy a policy? Then I don't have to pay the premiums as long. Am I better off doing that? Well, let's look at this chart. So let's assume that Karen goes on claim at age 80. If she purchased the policy at age 45, she would have paid that premium of 2,546 for 35 years. With a total amount of premium she would have paid in is 89,110. If she waited to age 50, she would have spent 95,000. Again, I'm not going to go through all the numbers, but you could see every year or every age group, it shows that she's going to have spent more on the premiums until we get to age 70. Age 70, you can see, is a little bit less than age 65 age group. But the problem is, if you wait to age 70, what's Karen's insurability going to look like? What is the chance that she would actually qualify for long term care? So here's a chart that shows you declines by age group. So long-term care declines. So age 49 and below, 12.4% are declined. And it goes up steadily. You can see age 70, 74, 47.2. So if Karen had waited to age 70 to purchase a policy, it's almost 50-50 chance that she would be declined for that coverage. And she would still pay a lot more than if she bought it at age 45. Another thing to think about is um, insur- insurability is family history. Family history is considered when applying for long-term care. So we work with two long-term care companies, Mutual of Omaha and NGL, National Guardian Life. With both of those companies, if the proposed insured has two immediate family members that have been diagnosed with a cognitive issue, Alzheimer's or dementia, they are uninsurable for coverage. With Mutual of Omaha, if proposed insured has one family member, immediate family member with cognitive issue, they're going to limit that person or the proposed insured to a $5,000 monthly benefit. NGL does not limit the coverage with one family member with a cognitive issue. So if the client applies at a young age, their parents are going to be younger and may not yet have been diagnosed with a cognitive issue. So, again, it doesn't matter what age your parents were diagnosed with a cognitive issue nowadays. It just means if they have been diagnosed at any age, that's going to be a strike against you when you're trying to qualify for long term care insurance. And also keep in mind, once people are on Medicare, they often take advantage of health screenings. And if a diagnosis is made, it will now be in their medical records. So if you have a client that's 65 and they've done these tests and now they have information in their medical records that wasn't there before, now they may be uninsurable for coverage. So bottom line, it's always a good idea to apply early while premiums lower and lock in insurability. So we generally recommend clients in their 50s, early to mid 50s apply for long-term care insurance. When you think about it, when they're in their 30s, 40s, they're worried about building up their assets. They have children in the home. They're worried about paying for college. But then once they get into their 50s, their focus has changed a little bit. They're more clients are going to be more concerned about the retirement. Are their funds going to last? And the kids are hopefully out of the home or independent, and that's when they can start looking at long-term care insurance. So now let's talk about long-term care policies. So if your client decides they want to consider a long-term care policy, what are the options on the market nowadays? Well, there's traditional long-term care insurance, which is just straightforward long-term care, provides a benefit if it's needed, no death benefit, no cash value, but good, solid coverage. Then there's hybrid life policies, these linked benefit policies, permanent life insurance policy with a long-term care rider. So best of both worlds, you have a long-term care benefit. If you don't need the benefit, then there's a death benefit for your beneficiaries. And then there's a hybrid annuity with a long-term care rider. This is a fixed deferred annuity with a long-term care rider. These annuities are very nice because there's very little underwriting on these hybrid annuities. So we've had clients that could not qualify for a traditional or a hybrid life policy, and they could get underwritten for a hybrid annuity. So let's look at the common features of these three types of policies: the long-term care, the hybrid life, and the hybrid annuity. They all provide the same type of long-term care benefits, meaning they can receive care in your home, assisted living or nursing home. Choice of benefit periods, 2 to 6 year benefit periods typically. They all have inflation riders, 4, 5% compound inflation. Some of the hybrid life policies still have simple inflation, and the hybrid annuity has compound inflation. For all three products, they have the same two claim triggers. Either client's been or proposed the insured's been diagnosed with a cognitive issue and needs round-the-clock care, or they need assistance with 2 out of 6 activities of living. So all three products provide great care, great types of care. So let's look at the differences between these three policies. So death benefit, no death benefit on traditional long-term care. Hybrid life, yes. And on the hybrid annuity, there's that annuity values. With the hybrid policies, as long-term care benefits are received, on the hybrid life, the death benefit is reduced dollar for dollar. On the hybrid annuity, the annuity value is reduced dollar for dollar. Return of premium. Typically, on traditional long-term care, there's no return of premium unless you add on a return of premium rider, which some of the policies still do offer. Hybrid life, yes. When I'm talking about the hybrid life today, I'm talking about the true linked benefit policies, where the emphasis is on the long-term care benefits, not so much on the death benefit. So we're talking about the policies Lincoln MoneyGuard, Nationwide, Securian. They do have some return of premium, and depending on the policy and how you design it, has some return of premium. And then the hybrid annuity does have whatever the annuity value is. If the client changes their mind, they can get that annuity value. Premium payment options. Typically, traditional long-term care is lifetime level premiums. NGL does offer a single pay or a 10 pay along with the lifetime premiums, but again, typically it's lifetime premiums. The premiums on traditional long-term care can be increased if the insurance company goes to the state and asks for a rate increase for every policyholder in the state, every policyholder with the same policy series in the state. Hybrid life premiums, these policies are designed to look most attractive when you do a short pay premium, like a single premium, a 5-year premium, a 10 pay premium. Some of the companies do offer a lifetime premium, but again, they look most attractive when you do a short pay. And premiums on hybrid life policies are guaranteed. So once a policy is put in force, they cannot be changed. Hybrid annuity, the only option to pay the hybrid annuity is a single premium of non-qualified money. Oh, sorry, I got ahead of myself here. Guaranteed premiums, not on the traditional long-term care, but yes, on the hybrid life and the hybrid annuity. Form of benefit payment. So long-term care policies are reimbursement. So this means once you go on claim, satisfy the elimination period, have to continue to pay for your care out of your own pocket. At the end of the month, submit invoices to the insurance company. The insurance company will reimburse the policyholder up to their daily or monthly benefit. With reimbursement, all care must be provided by skilled or certified caregivers, so cannot use family members, friends, or neighbors. Some of the majority of the hybrid life policies are indemnity payment. So what this means is once on claim, satisfied the elimination period, the insurance company will send the policyholder a check at the beginning of every month for their monthly benefit. They can use that check however they want. Care can be provided by unskilled caregivers such as family members, neighbors, or friends. And the hybrid annuity is reimbursement like the traditional long-term care. How about underwriting on the policies? Well, for traditional long-term care, it's full underwriting, medical underwriting. Most of the companies do not require you have an exam as long as you've seen your primary care physician in the last 24 months, had a checkup and lab work done. Hybrid life, we have to go through underwriting. Again, medical underwriting, medical records would be ordered. No exam is usually required, again, as long as you've seen your primary care doctor. Hybrid annuity, nice thing about the hybrid annuity is very limited underwriting. There is some medical underwriting, but it's very limited or much less or much more limited than traditional long-term care and the hybrid life. Partnership qualified. Traditional long-term care policies, many of them are partnership qualified for the partnerships between the states and the Medicaid programs. Hybrid life, hybrid annuity are not partnership qualified. So now that we've looked at those, let's look at some case studies. So here's Paul and Susan. They're both age 53 and they live in Dallas, Texas. They need some long-term care and want to know what their options are. They have no existing life insurance with any cash value, so any policy they buy, they'd have to write a check for it. And they have moderate assets, and they want a policy to help supplement a portion of their long-term care expenses. So when I say they have moderate assets, they have enough assets that they know that they could cover part of the expenses, but they would just like a policy to help supplement their own savings. So I'd start by looking at cost of care where they live in Dallas. Uh, 48,062 is home hair, home health care costs based on 44 hours a week. Um, if they wanted 24/7 home health care, yes, it's going to be a lot more expensive. Assisted living, 4195. Semi-private room in a nursing home, 5,627, and then a private room in a nursing home, 8,460. So again, they're looking for a moderate policy. So what would we recommend for them? We'd recommend they consider a monthly benefit of $4,860. And why is that? Because with that, they'd have 100% of home health costs covered. Remember, I said earlier, 73% of claims begin in the home, and very few end in nursing homes. So if you have home health costs covered, you're doing well. And with 4860, they'd have 57% of private room and nursing home costs covered in Dallas. So let's look at the two different options for them. Let's look at traditional long-term care and hybrid life policies. So we're going to look at 4860 monthly benefit, 90-day elimination period, 3 years with shared care. Again, this is for traditional long-term care. We recommend 3 years for couples. Male's average length of stay or average amount of care is 2.2 years, female 3.7. So having 6 years to share between them um, covers the most likelihood of events. And the next screen, I'll talk about how the shared care rider works. And 3% compound inflation, so that benefit will keep growing. So here are the two traditional long-term care companies we work with, Mutual of Omaha and National Guardian Life, or NGL. Mutual does a monthly benefit, so we can get the 4860. NGL uses a daily benefit based on $10 increments. So the closest I can get to 4860 is $160 per day. For both companies, we do the 3 years with shared care. So with Mutual of Omaha, the shared care rider allows them to share their coverage, but they have to save 1 year each to use if they're both living. So if the husband became sick, he could use 5 years of coverage, leave the wife with 1 year. With NGL, their shared care rider works differently. It adds a third pool of benefits that they would each have access to if they went through their own 3 years. So husband could use 6 years, leaving the wife with 3 years. With both shared care riders with both companies, when one spouse passes away, the surviving spouse only now has to pay their portion of the premium and has the shared care benefits or has whatever benefits are left. 3% compound inflation riders available. Again, there's no return of premium, no death benefit, and traditional long-term care reimbursement is the form of payment. And here's the premiums. So a little bit difference in premiums. NGL 4837, we'd probably recommend this one. Again, you get good coverage, you get that third pool, and it's less premium. So let's switch and look at a hybrid life policy for them. I talked about earlier what an individual hybrid life policy is, but now State Life has a second to die uh, joint hybrid life policy. So just to review what that is, it's a second to die whole life policy with a long-term care rider, and this policy pays a death benefit on the second death. Provides long-term care benefits for both of them so they can both be on claim at the same time. Choice of benefit periods, including a lifetime benefit period if they wanted it, and many premium payment options, including lifetime. So you could do, I believe, a single pay, a 5 pay, a 10 pay, lifetime premiums. So let's compare individual hybrid life policies for each of them. So with Nationwide, it'd be individual hybrid life for Paul and an individual for Susan. With the State Life, that's a joint policy, so one policy to share between them. With both of them, we can get the monthly benefit we want. With Nationwide, 4 year benefit period each. So 4 years each. With State Life, 66 months shared is the closest. So that means if they, let's say Paul and Susan both went on claim at the same time, they would be using 2 months of benefits. They could each use $4,860. But if they're using 2 months of benefits, the benefit period would last 33 months each. Total long-term care pool, So nationwide with the two policies, 487,980 for the two of them, and with the joint it's 364,000 to share. Both the inflation rider. So again, nationwide it's two individual policies, so we have two death benefits. Each policy a death benefit 116,640, and this single death benefit 162,000 with state life. Long-term care payment nationwide is indemnity, so the cash benefit, which is very nice. State life is reimbursement. Both have 90-day elimination. State life is 90-day elimination for facility care, but 0-day for home health care. Residual death benefit or guaranteed death benefit. So nationwide has a small guaranteed death benefit. So even if you go through all your long-term care benefits, use down that death benefit, you're still guaranteed that each have a 23,328 death benefit. State life does not have this residual death benefit. So here's the total premiums, and I ran these premiums as a 10 pay. So with nationwide, their annual premium each year would be 19,491, and that's for the two of them. With state life, their annual premium 21,337. So nationwide in this case is a better policy because they're getting two death benefits, they're getting a higher long-term care pool, and they're paying less in premiums. Depending on the age of the clients and the sweet spot, sometimes state life looks a little bit better or is a little bit less expensive. So you really have to consider both. Now let's compare all three products. So I'm going to compare the traditional long-term care, the individual hybrid, and the joint hybrid. And then we're going to assume that Paul and Susan both go on claim at age 83. So by age 83, with the traditional long-term care, they've paid a total premium of $145,110. That's assuming there's no rate increases. With the individual hybrid, $194,910, and the state life, the most expensive, $213,370. Look at the total long-term care pool. NGL's pool is so high. That's because of that shared care rider creates the third pool of benefits. Nationwide still has not as high a long-term care pool, but a very nice benefit pool, and state life a little bit smaller. Remember, no death benefit on NGL. Nationwide has the highest death benefit because it's being paid twice. No surrender value with NGL. Nationwide has the highest surrender value, and I show it right there for the two of them. NGL and One America are both reimbursement, and Nationwide is indemnity. So if your clients, the bottom line is if your clients want the Cadillac of policies and they can afford the higher premium up front, because remember these are a 10 pay, so they're going to pay a high premium for 10 years, but then they'll have a paid up policy, no more premiums. They get a large long-term care benefit, death benefit, some surrender value, so a good policy. But for those clients that maybe cannot afford those higher 10-year premiums and just want a lower level premium for lifetime, and their main focus is the long-term care, look at that long-term care benefit with the NGL policy. 1,238,445. That's 8.5 times what they've put into the policy having long-term care benefits. So good, still a good policy. Now, if they wanted lifetime benefits, we can do that. To get lifetime benefits, NGL does offer that for traditional. State Life has the lifetime benefits. If they're looking at lifetime benefits, level premiums here, just to give you an idea what those would be, with NGL, $8,829. State Life, $12,829, and they would have a death benefit of $162,000. If they want to do 10 pay, NGL does offer that. So with the 10 pay with NGL, that is a guaranteed premium of $27,148. State Life, $29,735. So if your clients are considering a 10 pay and a lifetime, I would recommend they go with State Life because at least they have a death benefit, and it's not a lot higher than that NGL policy. So here's another case study, Kent and Karen. So age 63 and 62. Kent has a life insurance policy with $132,000 of cash value. His kids are growing and out of the house. He no longer needs the large death benefit that policy provides him, but they want some long-term care coverage. But both of Kent's parents had dementia. So the advisor came to us and he had two questions. Could Kent qualify for traditional long-term care? The answer is no. Because of that family history, we cannot get him traditional long-term care. And could they use that 132,000 of cash value to provide them both with long-term care benefits? Well, the answer is yes. So Kent would be insurable for a hybrid annuity. So now they have to decide, do they want to do an individual annuity for Kent only or a joint annuity for Kent and Karen? So the annuity for Kent alone would provide that 132,000 $5,618 monthly long-term care benefit, 60-month benefit period, 90-day elimination period. But the nice thing about the joint hybrid annuity is the rules, the 1035 exchange rules, will allow us to take the money that is in Kent's policy, where he's the insured, roll it into this hybrid annuity, and add Karen on as a second annuitant. We're normally with the 1035 exchange rules will not allow us to do this with a hybrid life policy. So again, with hybrid life, we could not take this money that's in the policy where Kent is the owner insured and put it in a joint hybrid life and add Karen on. No, we cannot do that. But we can do it with the joint hybrid annuity. So if we did that, that cash value would provide a monthly long-term care benefit of $4,482 for the two of them, 66-month benefit period shared between them, 90-day elimination period. So they do have some options. All right, now let's switch gears here and talk about what's new in the long-term care industry. So what we want to talk about is these states that are considering a salary tax to fund state long-term care programs. So why are these states considering these? Well, they're because their Medicaid budgets are really stretched. Until the year 2030, there's going to be 10,000 baby boomers per day turning age 65. So with that many, with our aging population, our Medicaid budgets are really going to be stretched. So the states are looking for areas to help that Medicaid budget. So with these state long-term care plans, the plans would pay first and then Medicaid. So if somebody in a state, let's say Washington, that has one of these state plans, they would use that plan first, and then when they've spent down their assets, then they would be dependent on Medicaid. The state long-term care plans are focused on inexpensive home care, not facility care. So most of the care provided by Medicaid is nursing home care. They do allow now some home care, but most of it is nursing care. So these state programs would be focused on home care. What are the goals of these states that are looking at this? They want to provide the middle class with some type of affordable coverage, and they want to be able to stretch Medicaid funds by using the long-term care funds first. So Washington State was the first state to pass legislation for one of these state-funded programs, and they passed it in 2019. So this, after it was declined twice by legislatures, it was passed in 2019. So this means that on July 1st, 2023, employers will begin withholding a 0.58% tax on all W-2 employees. Self-employed individuals have the option. They can pay that tax or they cannot. So this tax will be used to fund a mandatory state-run long-term care policy. So the residents in Washington that pay the tax will have access to a small long-term care policy, a policy that will provide them $36,500 in benefits, so 1 year of benefits, $100 a day, and it will be adjusted annually for inflation. So these residents have to pay into this policy. They cannot use it until they've paid into it 3 of the last 6 years or 10 years total with not more than a 5-year gap. The policy is not portable. So right now it's not portable. So if they move out of state, they can't take this policy with them. So you could have somebody that for years pays into this, and when retirement moves out of state, then they cannot take it with them. Washington is looking at making some revisions to their plan. I think they've realized that maybe they didn't think it through. So what they've done since it was originally passed, they changed it. They will now allow out-of-state residents, so people that live in another state but work in Washington, are going to have to pay the tax. We're going to have to pay that tax, even though they don't live in the state. So they've changed it. So now those out of state residents do not have to pay that tax. They've made it so that military spouses don't have to pay the tax. And another revision that Washington is considering at this time is checking in with residents and making sure they have to go through a recertification process every 1 to 3 years. And I'm jumping ahead of myself right here. So what the state of Washington did was it gave the residents an option to opt out of paying the tax if they purchased their private long-term care policy before November 1st, 2021. So if they purchased a private long-term care policy, they had to check in with a website the state had established to show that they had a private policy. Then they would take that certificate to the employers, so the employers would know not to withhold that tax. So as it is now, you only had to check in with the state one time to show that you have a long-term care policy. So a lot of concern about people would buy the policy, check in, and then drop it. So the state is considering making residents recertify every 1 to 3 years. So these clients or these residents will not drop the policies. Another change Washington is considering is treating cognitive impairment as a single benefit trigger. So right now in the state of Washington, um, to go on claim, you have to need assistance with 3 out of 10 activities of daily living. Um, being diagnosed with a cognitive issue is just one of those 3. It's not a separate issue like it is on traditional long-term care. So what happened last summer and fall because of this in Washington? There was a private long-term care insurance was a logjam. You would not believe the amount of long-term care applications from Washington in the spring and summer of 2021. The insurance companies were overwhelmed with these applications, so they started implementing temporary minimum requirements. They required that you had an inflation rider on the policy, and then eventually they increased the amount of benefit that they would need, and then their main fear that those policies would be dropped after that 11/21 deadline or after clients certified with the state. So the insurance companies became so overwhelmed and they realized they weren't going to be able to process the applications in time of that deadline, so they suspended Washington sales in the summer of 2021. So what other states are considering a similar long-term care tax? You can see there's 15 states here that are considering doing the same thing that Washington did. They're studying Washington and hopefully learn from it. So California, Connecticut, Hawaii, Illinois, Massachusetts, Maine, Michigan, Minnesota, New Mexico, New York, North Dakota, Oregon, Pennsylvania, Utah, and Vermont are all considering it. These 3 states are the closest to it: New York, Pennsylvania, and California. So New York and Pennsylvania, again, they're strongly considering a payroll tax similar to the Washington CARES Act. The tax would provide contributing residents a small long-term care policy. Pennsylvania legislators are voting on this fall. New York legislators are voting January 2023. We've heard opt-out periods may be very short or non-existent at all. We've read that New York may require private long-term care policy be enforced for 1 year before the passing of the bill. So clients should really act quickly in New York if they would like to opt out of paying that tax. I didn't mention in New York that tax had no cap. So it didn't matter what your income was. It was everybody age 18 and over would have to pay that tax with no cap on it. I've read that in New York that tax could be as high as 0.99%. So again, I don't know what the tax will be. In Washington, we were a traditional long-term care policy or the hybrid policies did qualify to opt out. What I've heard in New York, I just heard this recently, is the hybrid policies may not qualify to opt out in New York. California payroll tax. In California, they put a task force together to study the feasibility of one of these taxes, and that report is due by January 1st, 2023. And then the California Insurance Department will look at that feasibility report and then submit an actuarial report by January 1st, 2024. They're considering a benefit pool of 36,000 to 144,000. We're not sure what that tax will be yet. It'll depend on how big that pool is. And the tax may be split between being paid by the employer and the employee. In Washington, it was all by the employee. We're not sure if California will have an opt-out provision. They may. If they do, it'll probably be very short. And think of it, California has 4 times the number of W-2 employees that Washington has. So if they do have an opt-out period, the insurance companies will be receiving a lot of policies, and it'll be interesting to see how the insurance company handles that. Will they stop accepting applications right away, or put other limits on the policies, on the applications? So let's look. If your clients have the option to buy a private policy versus pay that state tax, what's the benefit of a private policy over paying the tax? Private policies, you have more control on the design, the policy that meets the individual needs. So you can pick the benefit period, the benefit amount, the elimination period, and the inflation. So you control maybe your clients that are getting older and they need a policy anyway. Now is a good time for them to purchase a policy that meets their needs. And you don't need to be vested in a private policy. Remember I said in California you have to be vested for 3 out of 6 years or 10 years. Private policy may have lower premiums. So for your clients that are high wage earners, if they have to pay a 0.58 or 0.99% tax, the tax they pay may be a lot higher than the premiums on a private long-term care policy. And a private policy is portable. You can take it in any state that you want. So here's a chart we put together to show you break-even points on paying for a private long-term care policy, a very basic policy, or paying the tax. So by basic policy, in Washington, what clients needed was a $100 a day policy, 2-year benefit period, because that's the lowest amount available for private, so it's double the state plan, 3% compound inflation rider, 90-day elimination period. A 40-year-old male in New York would have a premium of $895. So if his income is $154,310 or more, the tax he would need to pay on the state program would be higher than that premium on the individual policy. You can see for a female age 40, premiums higher because long-term care premiums are higher for females, 1,313 for the private policy. If their income is 226,379 or higher, and they elect to pay the tax, they're going to pay more for that tax than they would for the private policy. And we're a couple. So when we talk about a couple, so if you have a husband and a wife, um, they're both 40 and they're both working in the state of New York, a joint policy for the two of them would have a premium of $1,877. So if their joint income is $323,621 or higher, the tax they would have to pay would be higher than their joint premium on the long-term care policy. I'm not going to go through all these numbers, but you can see where the break-even points are, and get an idea of who your clients, especially the young high wage earners, they should consider purchasing a policy. And here we're just a quick case study. So male in Pennsylvania, age 40, if he wants to look at options to opt out of the paying the tax, as of now, we believe that he could purchase a long-term care policy or a hybrid policy, anything that qualifies as a long-term care policy. So if he were to buy the minimum policy for traditional long-term care, 3,000, 2 years, 3% compound, premium $881. Or he could buy a guaranteed universal life policy with a long-term care rider, again the same $3,000 monthly benefit, Benefit period 50 months, so the long-term care pool is 2% of the death benefit. No inflation rider, no option to add an inflation rider on these. $150,000 death benefit, annual premium $1,555. So again, he's got a nice death benefit, $3,000 monthly benefit, and a guaranteed premium. The other option is an index universal life policy. For this one, we do, I believe it's 50% of the death benefit. No, I'm sorry, 4% of the death benefit would give him a $4,000 monthly benefit, 24-month benefit period, no option to add an inflation rider, annual premium of $3,000. And then the third option, if you would like a hybrid life policy, so these are these linked benefit policies, a true hybrid policy where the emphasis is on the long-term care benefit, that minimum long-term care benefit of 3,000, 4-year benefit period, 3% compound inflation. So your clients that are young and they want this benefit to grow, we can add on that inflation. So the death benefit, $72,200, a 10-year annual premium of $4,971. So after paying this premium 10 years, he has a paid-up policy. When he's retired, he doesn't have to worry about premiums. These are guaranteed premiums, and he can opt out of the tax. So here, just a way show you the different options for your clients that are in one of these states that are considering the salary tax. So to summarize, for your clients that live in the states that are considering the salary tax, they should act quickly, especially if they're high wage earners, especially those young high wage earners. We were receiving applications in Washington from clients that were 28 years old, 32 years old, 30. Really unusual, but for them it was beneficial for them to pay premiums on a long-term care policy than to pay that tax. And when you think of it, they're young, their income's only going to go up, so will the tax that they have to pay. Here, just that's finishing up the webinar, but here I want to just tell you about our annual Insurance Academy that registration opened today for this. So Protect Their Future. This is a 2-day event that we host every year. You can earn continuing education credits. We hosted at a hotel on the beach, Clearwater Beach, in February. So when the snow starts to fly and you're looking for some nicer weather, come on down and join us in Clearwater. Get some CE credits, learn about insurance, and have a good time. So again, registration is began for that today. I just want to make you aware why LLIS is different because of our free monthly webinars. Uh, we do pre-underwriting for your clients to help them find the companies that are going to fit them the best. We have specialists in life, disability, long-term care, annuities, and hybrids. So we concentrate on those areas to be in touch with what products are looking the best right now and maybe the best option for your client. And we proudly sponsor all these different organizations. Happy to help out with these different organizations, and we've been sponsors for many years. And we have our portal, our 24/7 portal named Alice, so you as advisors can look at your clients' policies, and when they're in underwriting, see where they are, and the clients or the insurers can log into the portal and look at their policies, or again, look at where they are during their underwriting process. So thank you everybody for attending today. If you have any questions, please let me know. Any questions I don't get to today before the time's up, I will send you an email with answers. So Claudia, any questions?
Yes, if you open up the chat, there are lots of questions.
Okay. Okay. Oh, so the first question is, why do men have shorter stays on average than women? Is it because they die earlier? Well, what usually happens is the male goes on claim first. They usually become sicker earlier. The female or the wife takes care of them. They pass away, and then the female has nobody there to take care of them. So time has shown that females go on claim longer and more often than males. So that's why about 7, 8 years ago, the long-term care companies went from using unisex rates to gender specific and now made the rates much higher for females. Okay, so this question, does the inflation rider begin increasing the benefit as soon as the policy is purchased or the year after? Or does it kick in when they begin receiving benefit? Well, the answer is the inflation rider begins the first policy anniversary. So every year on the policy anniversary, the benefit will increase. So if you have a 3% compound inflation rider, the policy will increase by 3% compounded every policy anniversary. It's not like disability insurance where the COLA rider doesn't kick in until you go on claim. So, question, is there a typical optimal age on when exploring long term care is recommended? An optimal cost versus risk as a long term care event. So, as I mentioned in my presentation, I don't have an exact age when somebody should start exploring long term care. Usually, we'd say in the early to mid 50s. Um, then that is when their client's focus is shifted from looking at building up their assets to being concerned about retirement and how long will the assets last. And then you really, for optimal cost versus risk on the long-term care event, I think you really just need to look at how much a long-term care event could cost you and what are the consequences of that and how can your assets handle that. Would you like to transfer some of that risk to the insurance company? So, question is, how does an adult child purchase long-term care or hybrid life insurance for parents? So yes, a child or can purchase a policy on the parents, but the parent does need to be involved. They have to be okay with it because the applicant or the parent would have to help with answering or completing the application process, and they have to sign off and allow their medical records to be obtained. So the insurance companies don't care who pays the premiums on the policies, but they do have to be in touch with the person that's actually going to be insured. So the child can pay the premiums, but the insured would be the parent. So yes, that can be done, no problem. So question is, what are the most common reasons for a policy decline when applying? I would say most declines are related to muscular or skeletal issues. So, clients that have some issues with their back, or maybe they're receiving some physical therapy because they're having knee problems or hip problems, or if a client or arthritis. Arthritis is a very big or very common reason to be declined. So anytime you have clients that are receiving physical therapy or some type of treatment for an ongoing issue with joints or muscles, that's always going to be either a postponement or a decline. If you have clients that have been knee issues and they need to have a knee replacement, if they go ahead and have that knee replacement surgery, and it's successful, 3 months after that, if they're fully recovered, finished physical therapy, then they may be insurable. So these issues are not always a decline, but sometimes a postponement. So musculoskeletal are most common issues. Can you please review the inflation riders for each of the long-term care options? That really depends on the company, but for traditional long-term care, the companies we work with, 3, 4, 5% compound inflation. I believe that we are done for today, and any questions that I did not answer, I will send you an email with the answers. Thank you all for attending.